Greetings, everybody. Welcome to the Liberty Call. Today is Thursday, December 15th, 2022. Hope everybody's having a good day out there. It's kind of gloomy here in Colorado. We had a snowstorm come through the other day, and not too bad here west of I-25, but to the east, whew, they got clobbered. I mean, they got snow drifts like 6, 7 feet high and out there on the eastern plains and, well, as I call it, western Kansas. But Colorado's kind of weird. It's like, got this square state, and then like half of it is all mountains, and then the other half is flat as a board. So, anyways, but yeah, I mean, the mountains got some snow, but right along the I-25 corridor where you got Denver and Colorado Springs, and I live between the two, we just didn't get much, but did have to go out and clear a little snow off the driveway that hadn't melted yet because I didn't want the Amazon guy falling on his ass when if he comes up the driveway, and don't need that lawsuit. So. Anyways, if it's your first time watching, please give me some big old thumbs up, like, share, subscribe. I greatly appreciate it. If there's some people out there you think might get some value out of some of my nonsense that I spew on a daily basis, feel free to send it out to them. I'd greatly appreciate it. So pretty ugly day in the markets. We did have the Fed decision yesterday, which has people, hang on a second, let me close my office door. My wife's playing with the dog upstairs, and don't need to hear the squeaker during our broadcast. But yeah, we did have the Fed broadcast or the Fed announcement yesterday. They did raise rates by a half percentage point or 50 basis points. And the market did not like it. I mean, again, anyone who's been watching this, knows my views on it, that, rates really need to go up probably north of 6%. I probably would have gone higher earlier in the year, but these chicken shits are so worried about, tanking their investment portfolios, and they don't want to hurt their friends in the big finance. So they've been just nibbling away, eating that elephant one bite at a time. But, the market didn't react well yesterday, and it definitely didn't react well today. So, again, I don't know what people are expecting. I mean, did they think that, and I'm going to talk about go through some commentary on Powell's speech yesterday. And I just don't understand. I mean, did the stock market think that he was going to give some guidance to say, yeah, well, we've done enough. We're going to start lowering rates. And, maybe we'll even do some quantitative easing, and, we'll start inflating the economy again, because we've seen how well that has worked out over the last couple of years. So anyways, it's a little, again, anyone who's paying attention and has an understanding of basic economics really should understand what's going on. But again, these financial journalists are trying to will it into existence that they're going to get rates back down to zero for another decade. And again, we see the carnage that this is created, and now we're having to dig our way out of this hole. So it's kind of like the people on the Eastern Plains. I mean, they're having to dig their way through snow drifts. All right, well, let's go ahead and see how the markets did today. The Dow Jones was down 2.25. Closed at 33,202. The S&P 500 was down 2.42, closed at 38.98. NASDAQ was down 3.23, closed at 10,810. Small caps were down 2.25 also. The VIX was up 7.62. It's currently at 2276. Canada was down 1.46. Brazil down 0.09, so basically flat. Mexico down 1.36. Let's look at the European markets. Germany was down 3.28. UK down 0.93. France down 3.09, Euro stocks down 3.51. Was that Netherlands? Yeah, Netherlands down 3.18, Italy down 3.45, Switzerland down 2.51, and Portugal down 0.96. Both Russian exchanges in the red. MOEX down 1.53, RTSI down 1.77. And the overnights in Asia, Japan was down 0.37, Australia down 0.64. The Chinese markets mostly red also. The Shanghai down 0.25%. SCSE component up 0.32, the one bright spot there. And China A50 down 0.11. DJ Shanghai down 0.16. Hang Seng down 1.55%. And the Taiwan weighted pretty much flat at down 0.04. So like I said, most of the global markets evidently didn't, really like the Fed's message either. And but again, until we get things back under control, I just don't see, I don't see the markets, having this, rallying back to above the peaks of the beginning of the year. And secondly, I don't see the Fed. I mean, they could. I mean, if they say, well, we don't know if we're going to go into recession. Well, buddy, I think we're already there. And secondly, if they may turn tail and pivot, like they like to say, the Fed pivot or the Powell pivot, something that you might read a lot in the news. I just don't see it happening anytime soon. All right, well, let's read through today's market recap, see what they had to say. Stocks are falling on fears of Fed's higher rates for longer. Again, they try to talk about it in terms of, oh, we're shocked. I can't believe this is happening. All right, U.S. stocks slumped more than 800 points on Thursday as investors reacted to the Federal Reserve's higher for longer stance on interest rates. The Fed put out a fresh set of forecasts on Wednesday that show inflation remaining elevated while expectations were for growth in gross domestic product to slow while unemployment rises. The Fed said on Wednesday that its benchmark rate would likely top out above 5%, which is higher than expected just a few months ago. Again, who was expecting them to raise rates to 3% and magically it's all fixed? I mean, again, it's insane. And indicated it wasn't inclined to pause or pivot the rate cuts anytime soon. That is pressuring stocks as investors had hoped for the turn sometime in 2023. Central bank raised its rate by 0.5 percentage point as expected, slower than the pace of hikes at its 4 earlier meetings this year. Chair Jerome Powell said there are some signs of inflation cooling, but not enough evidence to convince the policymakers that the inflation was on its way to a sustained direction towards the target 2%. Traders are expecting another 2 rate hikes next year, each of at least 0.25 percentage point. Again, I think they're probably going to wind up doing 0.5%, but again, it's early to tell. I'm not sure when their next Fed meeting is. It's probably February or March, if memory serves me. Data on Thursday indicated a steeper than expected drop in retail sales. Meanwhile, new unemployment data dropped last week and were lower than expected. Both the European Central Bank and the Bank of England raised rates by 0.5 percentage point. Shares of Tesla rose 0.3% after CEO Elon Musk disclosed another $3.6 billion in stock sales. The stock is down more than 55% this year. Shares of Netflix fell 8% after a report that its new ad-supported subscription tier was falling behind the viewership goal it promised advertisers. Oil fell. WTI was down 1.4% to $76.17 a barrel, while Brent futures were down 1.4% to $82.59 a barrel. Gold futures were down 1.7 to $17.88 an ounce. So kind of a day across the markets. I mean, typically when the stock market's down, you might see your commodities come up, but especially gold and your precious metals, but not today. All right, well, let's read a little bit about the some economic data. U.S. retail sales post biggest drop in 11 months. Labor market is tight. U.S. retail sales fell more than expected in November, but consumer spending remained supported by a tight labor market, with the number of Americans filing for unemployment benefits decreasing by the most in 5 months last week. The biggest decrease in retail sales in 11 months reported by the Commerce Department on Thursday was likely payback after sales surged in October as Americans started their holiday shopping early to take advantage of discounts by businesses desperate to clear excess inventory. Still, the weakness in sales suggested higher borrowing costs and the threat of an imminent recession were starting to have an impact on household spending. Again, if you think that we're going to get out of this without some sort of market calamity or economic calamity, I mean, the Fed and our government are, just geniuses. But again, looking back at the last, 3 years now? I mean, because it's been 3, as of February or March, it will be 3 years since all this, super sniffle stuff started and all the mayhem around that. These people have been wrong just about everything. Oh, well, if we shut down everything for a few weeks, everything will be fine. Well, that didn't work. Well, if you wear rags on your faces, it'll stop, spreading stuff. Well, that didn't work out. If you get jabbed with something, it's, no one's ever going to get sick again. Well, that didn't work out either. So again, these people are full of BS. And again, I hate to be so jaded about this. I mean, these are supposed to be the people that we trust to make decisions for us. But I think they're just bought and paid shills who sell out to the highest bidder. And, it's a shame. There are very few noble people in government. I mean, I can think of Ron Paul, or not, yeah, Ron Paul was a good guy. His son Rand is excellent for the most part. Lee in Utah and Thomas Massey. I mean, those are four people I can think of. The rest of them are all just scumbags. All right, let's get back into this. Quote, the lack of follow through in November suggests consumers are being much more cautious with their money amid recession fears and the draining effect of overall high inflation and sharply rising borrowing costs, end quote, said Sal Gutierrez, a senior economist at BMO Capital Markets. Retail sales dropped 0.6 last month, the biggest drop since December of 21. After an unrevised 1.3% jump in October, economists polled by Reuters had forecast sales dipping 0.1%. Retail sales, which are mostly goods and not adjusted for inflation, increased 6.5% year on year in November. Consumers have been drawing down savings to fund purchases. The savings rate was at 2.3% in October, the lowest since July of 2005. Sales at auto dealerships fell 2.3% last month as motor vehicles remain in short supply. Receipts at service stations dipped 0.1%, reflecting lower gas prices. And on the labor front, a separate report from the Labor Department on Thursday showed initial claims for state unemployment benefits declined 20,000 to a seasonally adjusted 211,000 during the week ending December 10th. Last week's decrease in claims was the largest since July and pushed them to a 3-month low. Economists had forecast 230,000 claims for the week for the latest week. Claims have stayed below the 270,000 threshold, which economists said would raise a red flag for the labor market, despite a wave of layoffs in the technology sector. Yeah, those poor folks at Twitter. Businesses are generally reluctant to lay off workers, having struggled to find labor in the aftermath of the COVID-19 pandemic, a fact that was acknowledged by Fed Chair Jerome Powell on Wednesday. Powell described the labor market as, quote, extremely tight, end quote, adding, quote, it feels like we have a structural labor shortage out there, end quote. There were 1.7 job openings for every unemployed person in October. The claims report also showed the number of people receiving benefits after an initial week of aid, a proxy for hiring, rose 1,000 to 1.671 million in the week ending December 3rd. While that was the highest reading since February, the pace of increase in the so-called continuing claims has slowed from prior weeks. So again, I don't understand these people who are financial journalists. They should, again, have some, maybe they graduated college 5 years ago and didn't live through the financial crashes of, the dot-com bust and I was an advisor during 08 and 09. Typically the layoffs are after the fact. Usually the market goes to crap and then you see the massive layoffs and all the problems there. So again, I think a lot of it's just wishful thinking on their part. All right, well, let's go ahead and read through this economic report. Comes from Brian Westbury at First Trust. It's titled More Work to Do. It's basically his synopsis of Jay Powell's press conference yesterday. So we're going to read through this and see what he has to say, and then we'll go ahead and wrap things up for the day. The Fed downshifted to smaller rate hikes, but it isn't close to done. In contrast to the 75 basis point rate hikes at each of the last 4 meetings, the Federal Reserve raised short-term rates by only 50 basis points a day as expected. However, the Fed made it clear in its projections at the press conference that it is tilted towards further rate hikes in the months ahead and more rate hikes than the markets have been pricing in. Today's Fed statement was virtually identical to the one in November. The economic projections released at the same time brought a lot more to digest. Economic growth expectations were raised modestly for the year, but 2023 growth was cut from the 1.2% real inflation adjusted rate the Fed forecast in September down to 0.5%. So that's a pretty big drop. At the same time, the 2023 PCE inflation expectations were raised to 3.1%. We would take the over from 2.8%, and the unemployment rate moved to 4.6% from 4.4%. It'll probably go over 5% once we get into a real deep recession. Despite weaker growth and unemployment outlook, the dot plot showed a higher path for rates, with the median for finishing 2023 at 5.125 versus September's 4.875 forecast. The Fed is clearly showing that despite the pain on the employment side of the dual mandate, inflation is the priority, and a look at the distribution of rate hike forecasts for 23 and beyond shows that many members believe a higher endpoint for rates will likely be appropriate. Case in point, while the 23 median dot stands at 5.125%. 7 FOMC members believe the rate should end the year even higher, while just 2 believe rates should end lower. During the press conference, Powell was pressed for more details on what path forward would look like. Nick Timirios, the Wall Street Journal's Fed reporter, who many watch as an unofficial mouthpiece for Powell and Co., asked if the Fed can now transition to 25 basis point hikes moving forward until they reach their terminal rate. While Powell wouldn't commit to the size of the next hike that will likely come early February, he suggested that the Fed has now moved to a stage where smaller hikes look appropriate as they close in on the terminal rate. Powell was also asked when rate cuts would come into play. Again, these people want to cut rates already. I mean, rates in here. Let's look at this chart right here. Let me zoom in. Look at this is the chart going back to 2008. I mean, we were at 3% when they started chopping rates back in 2008, and I mean, it's insane. I mean, if we go and look at one of the longer charts, I mean, I was around back. I mean, I was buying and selling houses and cars and stuff, in the 90s when interest rates were between 5 and 7%, depending upon what was going on in the world at the time. And these people already want to start chopping them down now. It's like, dude, we're in the middle of an inferno of inflation, and you're wanting to already, chop rates. So, all right. Powell was also asked when rate cuts would come into play again. He remained non-committal, but did say that the dot plots for 23 do not include any rate cuts between now and the end of next year. Finally, Powell was asked directly if a recession in 23 would cause the Fed to start easing policy sooner, to which he stated that they are tasked with promoting maximum employment and price stability, and in parentheses, inflation. The employment market is running hot while inflation is well above the Fed's target. And in his Q&A, I mean, he talked about, hot labor market. I mean, he just pounded that into the ground. So again, I think they're really paying attention to that. Where was I? In other words, the Fed is comfortable continuing to raise rates even as unemployment rises, at least modestly, while they aren't forecasting a recession in the year ahead. And in parentheses, Mr. Westbury and we are. In parentheses, it doesn't change their priorities. The bottom line is that it's good the Fed has prioritized the fight against inflation, but the necessary path to get there will likely bring volatility and short-term pain to the financial markets. We expect markets will end next year largely flat from where they stand today, but the market could see notable pullbacks along the way. The economic medicine, while bitter, is part of the price we pay for the policy mistakes made over the past few years. Done. Oh, sorry, I didn't have that on the screen. It was right here. All right, so yeah, it's crazy. I mean, these people want to, already go back to, it's like, give me that heroin. I'm ready to go. And it's like, dude, you're going to OD. And, I mean, if people want to run this into the ground, but another thing is I find it funny that they blame everything but themselves. I mean, these are the folks who created this problem. The Fed and the federal government, working in cahoots with each other, created this issue by printing all this money and all the quantitative easing and all the, stimulus and government handouts and overspending by the government. They create this issue and then stand around like, this is crazy. What happened? It's like, really? I mean, you didn't think that this was, and that's a question I'd love to be in that room and say, Mr. Powell, did anyone consider printing $5 to $6 trillion in the last year? Did anyone consider that might create some inflation? Did it ever come up? Because I'd love to see the notes. I'd love to see the meeting minutes that probably the minutes that they don't show the rest of us. I'd like to see or hear the discussion of that because I have to imagine that one of the 400 economists that works at the Federal Reserve might have broached that subject. We could have avoided a lot of this. Again, we probably didn't need to shut down the economy. I mean, again, it's just aggravating. But if that's everything I had for today. But if you want to get your crap together and navigate this mess that our overlords create, give me a ring. Go to my website, DSA Financial Group. Book a meeting. I'd be happy to talk to you about how to get your stuff in order, get your finances in a place where put the sandbags up around your house. So, when the flood comes in, you don't lose everything. But anyways, All right. Well, like I said, that's everything I had for today. If anyone needs anything from me, please go to my website. My email address is right here on the screen, and I'll talk to you guys next time. Bye-bye.